Hello and welcome to the look ahead for Tuesday, the 21st of January with me, Fiona Cincotta, Senior Market Analyst at City Index. So just taking a look at what we'll be focusing on tomorrow, although I'd have to say I think the main focus is going to be on the fallout from, or the reaction, should I say, to Trump's inauguration speech and immediately policies, executive orders, which he'll be signing off, which we don't still yet know at the time of recording. He hasn't had the inauguration speech yet, just about half an hour out, but there are reports that Trump will be less aggressive as far as trade tariffs are concerned than originally expected. So we're going to see that reaction already playing out on the markets today, most likely a follow-through reaction tomorrow. But there is also some data points to be watching out for. We've got German ZEW economic sentiment. We've also got UK labour market data, Canadian inflation, and earnings from Netflix. So let's just start with UK unemployment, expected to hold steady at 4.3% in the 3 months to November, but wage growth is expected to tick higher to 5.5%, up from 5.2%. Now, the trend for unemployment is a gradual weakening of the labour market. We've seen unemployment gradually trend higher, even though it's expected to hold steady in this the 3 months to November. It is expected to ease to around 4.6% by the end of this year. However, the Bank of England policymakers will be looking at they'll be looking at the wage growth more closely, given that wage growth tends to be intrinsically tied to service sector inflation. So there's going to be some watching of that as far as the Bank of England policymakers are concerned. They're also, higher intentions are expected to be weaker from companies who have been surveyed recently, particularly from Deloitte, following the Rachel Reeves' budget at the end of October. And the data that coming after weak data last week. We obviously saw weaker than expected UK inflation is 2.5%, still sticky though above that 2% target. GDP growth was weaker than expected at 0.1% month on month in November. And retail sales also unexpectedly fell, which would explain why we saw this weakening of sterling US dollar. Really fairly depressed below those 122 levels, but we're seeing this 1% jump up today, and that's what I said that we've just seen as a reaction to the report in the Wall Street Journal just in the past half hour or so. So as far as levels to be watching, if we get signs of weak labor market data, if we're seeing the US dollar fall off anyway because of a less aggressive Trump stance as far as tariffs are concerned, then we could find that sterling US dollar does pick up anyway, because that just means that the divergence that we had been seeing with regards to the outlook for inflation between the US and the UK would be slightly turning, and we could potentially see the same number of rate cuts, if not more rate cuts, from the Federal Reserve than the Bank of England. That could give the pound a bit of a boost. A couple of levels to be watching out for. As I said, you've got that 123 level, which we're just testing at the moment. Above that, this is this trend line, which dates back to 2007. Above there, you've got the 125. Weak data, or here, if we hear more aggressive comments from Trump as far as tax cuts are concerned, for example, or immigration policies, and that should that have a positive effect lifting the US dollar, then we could see this pair fall lower. 120 is the level to be watching on the downside. Now we're just going to pick up here on the US dollar, because obviously this is a currency which has been very much under pressure on concerns over trade tariffs. We can see this rise above this level here at the 103. 40 the 103.40 level. You can see that bullish engulfing candle. It's looking to test the falling trend line that dates all the way back to September. If we get a rise above there, then we'll be looking to this level around here, around the 104.50, 104.60 level. A rise above there will create a nice firm higher high, changing the structure of that chart. On the downside, if we do get, as I said, a strength in the dollar after this comments from Trump this evening, look out for 103.40 on the downside. That's the November low, before bringing that 102 level, which was the 2025 low, into focus. But as I said, I think, given that we're seeing a less aggressive stance from Trump, actually that's pretty beneficial as far as the euro is concerned. It does feel that those concerns over trade tariffs knocking growth in the eurozone do now feel a little bit overplayed, and we're seeing a response to that in the euro recovering. Let's just now take a look at what's going on with the US dollar CAD. Obviously, the Canadian dollar was one that was in line, or Canada, the Canadian economy was in line for trade tariffs in the region of 25%. So we're actually seeing a pretty good recovery in the loonie here. It's fallen sharply back from those 4-year highs that we were trading up just below the 145 level, and is now testing already that support level here of the 143. That's a level which has been tested a couple of times over the past month or so. Sellers are going to need to break that down in order to create a lower low and extend losses towards the 142 level. We've also got inflation data from the bank from Canada out tomorrow. So it's just worth keeping in mind. Inflation data is expected to show that consumer prices fell 0.5% month on month in November. That's down, in December. That's after they were 0% in November. On an annual basis, we're expecting a decrease to 1.7%, down from 1.9%, but well within the Bank of Canada's 1 to 3% target levels. So we can expect to see another rate cut from the Bank of Canada when they meet at the end of this month. Now, the Bank of Canada has actually cut interest rates quite aggressively. It's been one of the more aggressive central banks as far as rate cuts is concerned, cutting 1.75% so far. Now, obviously, that's quite a lot more than the Federal Reserve, which is why we've seen the rally in USD CAD. So if we're sort of starting to get this idea that maybe the Federal Reserve may cut a little bit more if we don't have such inflationary measures in the US, that's going to be bringing the US dollar lower, which is going to be bringing USD CAD a little bit lower as well. So yeah, as far as the inflation data is concerned, that's probably going to be supporting the fact, or supporting the view, that the Bank of Canada will cut again by 25 basis points at the end of the month. With expectations of not such aggressive trade tariffs from Trump, then potentially that could mean that the Bank of Canada could take a breather and in order to assess what happens next. Obviously, the rate is close to a neutral rate now. So if there were going to be aggressive trade tariffs, then that would have had a slightly different effect. It would have had a stronger disinflationary effect on the economy, which means that we would have potentially seen a further weakening in the loonie. But that's not the case. As I said, we're looking for a breakdown below the 143 to bring 142 round number into focus. For whatever reason, if we get a quick turnaround, then we'll be looking on the upside at 145. If we get a rise above that 145 level, that's going to create a higher high. Also, just worth keeping in mind whilst we're talking about the loonie, what's going on in oil prices, because oil has fallen quite sharply as well, and that's on reports that that President Trump, these are unconfirmed reports, that he may apply or he may be looking to ease sanctions on Russia in exchange for an agreement over the end of the Ukraine war. Also looking to increase output of US oil and gas, which is bringing those prices lower. But we'll know more when we hear from Trump a little bit later and see what those executive orders that he is busy signing away are saying. And then just finally, we've also got earnings season, which is ramping up. And tomorrow it is the turn of Netflix. Now, Netflix are expected to report earnings of $4.21, and that's on revenue of 10.11 billion. Basically, we're expecting to see some encouraging upbeat numbers, subscriber numbers potentially doubling from Q3, from the around 5.1 million to 11.1 million potential subscribers, although this will be the last quarter that Netflix will be reporting the subscriber numbers, as they shift their focus more towards the financial side of things. Expecting to see Netflix supported by strong content releases. You've got Squid Games 2, you've got live NFL games that have supported that and driven this demand, this increased demand that we're seeing. Also still receiving the positive impact from the tiered advertising. Just as far as the share price is going, look, we've seen it traded at all-time highs there at the end of mid-December, up at 9.41, dropped down here to around the 8.25 level. That was in line with weakness that we saw across the markets on concerns over sticky inflation, rising treasury yields. But as that's come back sort of to calm down, we've seen the share price has rallied. Obviously, share prices in the US are closed today due to Martin Luther King Day. So when we open tomorrow, we could see a better reflection of what's going on with the Trump optimism and also with earnings. But on the upside, we're going to be looking for a rise above the 870 level. That's going to bring 900 and 941 into play on the upside. So thank you very much for watching. I hope you've enjoyed everything that you've seen, and I will see you tomorrow.